ho! Welcome back to the Fit Finance Sessions Advent Calendar opening. We're getting close to Christmas now. I hope you're all excited. Now, I know Mum and Dad might be thinking of giving away some gifts and stuff like that this year. And one of the reasons I've heard some of the more boring ones talk about it is for inheritance tax planning. Tom, what is inheritance tax planning and how does it work?
So inheritance tax is a tax at 40%. And there's ways you can mitigate that. The easiest way is to insure it, or insuring against your liability. So if you know what your liability is, like Tim explained about whole of life previously, you can take out an insurance policy to pay the tax bill when you get there. Some of the other methods revolve around gifting into trusts on a 7-year cycle. So you can gift up to £325,000 each, which is your nil rate band. You gift that into a trust, and after 7 years that gift has left your estate for inheritance tax purposes. And there's generally 2 ways you can do that. One's through a discounted gift trust, where you get a fixed income from the trust, and you get a bonus amount that leaves your estate straight away, and the rest will disappear after 7 years. The other alternative is called a flexible reversionary trust, and that's where you put the gift in £325,000 each. After 7 years, it leaves your estate, and the growth on that money is outside the estate from day one, but it gives you a lot more flexibility about how you choose to take the money back. So you don't have to take a fixed income. You can take chunks of the money back over time within the rules of the arrangement. So there's some ways you can use to mitigate on a longer term scale.
Okay, that sounds interesting. But they take 7 years really on the whole to get most of the money out of the estate. Tim, is there a way that I can do it a little bit quicker?
Yeah, absolutely. So there's 3 main avenues really that you can do it quicker, all sort of fundamentally around the same concept, what's called BPR, business property relief. And that's a really set out by the government, where basically you invest in shares of companies which benefit from that relief, and after 2 years, the value of those shares or the value of your investment is outside of your estate for 100% in the eyes of inheritance tax. So quite simply, avenue 1, you can invest in what are quite literally called BPR schemes, where you are quite simply investing in clearly younger companies that benefit from the relief, and therefore you get relief after 2 years. Second is the EIS avenue, so the enterprise investment schemes, which we've done a podcast many moons ago now, on where same concept, you get the inheritance tax benefits and the CGT capital gains tax benefits as well, but you also get the third chunk of the pie as the inheritance tax relief after 2 years as well. And then of course there's a third one, which is the AIM market, so investing into companies that are listed on the AIM markets. That's the alternative investment market. So it's still a UK registered stock market, but much smaller than that of the more common FTSE divisions, which most people know, FTSE 100, 250, etc. So conceptually, you're still around the same kind of thing, that you're investing in younger companies, and as part of taking that risk, one of the benefits is that you get this relief of IHT after 2 years.
Sounds pretty good. Go on, there must be a way I can get money. I can get money and reduce my estate even quicker than that. Is there anything else I can do?
You tell us, Santa.
What about just spending it right away? Just go and buy the most expensive bottle of claret you can for your Christmas lunch and drink it. Thanks very much, guys. Bye-bye.